Hello, everyone. In this session, we are going to be discussing case study 5.3 of the study guide. This is around business combinations. So my hope is that this will give you a better understanding of this topic. So that is the question there. Parent Limited owns 70% of the issued capital of subsidiary Limited. During the year ended 30th June 20x4, these are the transactions that occurred. Subsidiary sold inventory to parent at a profit of 40,000. Now, the next statement is very important. The inventory was still on hand at 30th June 20x4. What does that immediately tell you? There is unrealized profit because this inventory is still sitting within the group. Second point, parent sold plant to subsidiary for $50,000 at a profit of $10,000. The plant was still on hand at 30th June 20x4. What does that tell you again? Unrealized profit. There is some unrealized profit there because that plant is still within the group. All right. The plant was sold by parent to subsidiary on 1st July, so at the beginning of the year, and was depreciated on a straight line basis. The plant had a useful life for 5 years with a scrap value of nil at the end of that period. Subsidiary provided parent with management services, which it charged $30,000. The following items were extracted from the consolidated worksheet for the year ended 30th June 20x4. Now, so you can see there that we have the parent company, we have the subsidiary company, we have the profit clearly indicated, the opening retained earnings, the dividends paid, as well as the closing retained earnings. So that equity section is very clear to us here. Now, I want you to just familiarize yourself with these figures here because we're going to be utilizing them to calculate a number of amounts or figures. So assume a tax rate of 30%. Now, we are also given financial statements for the year ended 30th June 20x5. So you can see these are two different periods. We have 30th June 20x4 and we have 30th June 20x5. And again, exactly the same information is provided. Now, what is the question requiring us to do? We are required to calculate the non-controlling interest. Now, I know by now, hopefully you now know that when we talk about non-controlling interest, we are talking about that minority interest. That particular component that is not owned by the parent company. All right, so how do you start calculating that? In my view, the best way to do this is to clearly show this diagrammatically or just using a diagram. So essentially what you do is you have the parent, you have the subsidiary, you know that these two entities transact with each other. The question is, are there any of these transactions that went on to an external party on both sides? So this is why I have this diagram here. So we have the subsidiary company here, we have the parent company. Now we know that there's some transactions between the subsidiary to the parent and vice versa. But there are also some transactions from the subsidiary to external parties, as well as from the parent to external parties. Now, why is this important? This helps you know whether a certain transaction contains unrealized profit or not. So the first one to talk about is inventory. The subsidiary sold inventory to the parent company. But we are told that that inventory was still at hand on 30th June 20x4. Consequently, it hadn't been sold to external parties as at 30th June 20x4. What does that tell you? There is unrealized profit. We need to adjust for that. Now, what else do we see? We see that the parent company also sold a plant for 50,000, made a profit of 10,000 to the subsidiary. The question is this plant still within the group or has it been sold off to external parties? Now, we are told in the question that this particular plant was in the group as at year end. So that actually tells you that there is an unrealized profit as well, which needs to be adjusted. Now, we also have management fees. Now, there is no unrealized profit on this. And so consequently, no need to adjust this item here. Now, The question tells us that after the end of the year 30th June 20X4, that inventory was sold during the year 30th June 20X5 to external parties. That essentially means that that unrealized profit has now become realized. So that should be able to give you a very good understanding of what has actually happened, what is unrealized, what is realized. So let's now look at how do you calculate the non-controlling interest in this entity as at 30th June 20X4. Now, you obviously start with opening retained earnings. So when you start there, remember, the non-controlling interest owns 30% of this company. And consequently, we know from the financial statements that the opening retained earnings, the total was 40,000. So the non-controlling interest owns 30, and so it's very straightforward that the portion for that non-controlling interest is 12,000. Now, the good thing is we don't need to adjust this amount. Why? Because we are told that there are no fair value adjustments of assets and liabilities that need to be made. So these assets and liabilities are, there's no requirement to make any further adjustments to them. And that is a good thing. So you can just directly apply the 30% on the 40,000. So then what's the next thing when you're looking at the equity section? So you now have looked at the opening retained earnings. What's the thing that increases or decreases the earnings of the company? Profit for that year. So we now want to look at profit. What is the component or what is the portion that is owned by the non-controlling interest? And so what we say is, we know that there are 3 intra-group transactions that occurred in the year. So as much as this subsidiary made a profit of a certain amount, there are some intra-group transactions that occurred. And it is possible that some of these carry what we refer to as unrealized profit that needs to be adjusted. Why? Because that profit is not really profit. It hasn't been earned yet by the group. And so what we do is we first start one by one. So when you look at management fees, there is no unrealized profit, and that is great. No need for any adjustments. But however, when we look at the sale of inventory, the subsidiary sells the inventory to the parent company, but that parent company has not sold it to external parties. Therefore, that profit that the subsidiary made, from a group perspective, not really a profit. It's what we refer to as an unrealized profit, and therefore that needs to be adjusted. What else do we see? So how do we calculate that unrealized profit? We know it's 40,000, but remember, we won't just adjust the 40,000. So we won't just reverse or eliminate the 40,000. We will say, yes, we should eliminate the 40,000, but we were taxed for this 40,000 at a subsidiary level. So we need also to reverse that tax effect, so that we need to consider that tax effect. And so that's why you find that we are actually reducing not by 40,000, but by 40,000 minus 12,000. Yeah. And so the tax effect is 30% of that 40,000. And you know that anytime you make a profit, you're taxed on it. And so what is that adjustment there for? So what we are saying is, yes, the subsidiary made 200,000. Yes, the non-controlling interest owns that 30% of that 200,000, but not too fast. Part of that amount is actually not earned. It's not realized. And so we need to deduct that. And so that's why we deduct the 40,000. But we say, hang on, we were also taxed this amount, so we need to reverse that. So one is a negative, another one is a positive. And so the total effect is minus 40 plus 12,000. So we have 30% of 172,000. And so now the total non-controlling interest in the profit is 51,600. So I'm hoping that that is very, very clear. Now, I want to ask you a question. Why is it that we did not consider the unrealized profit in the plant that was sold by the parent company to the subsidiary? Why is that? I want you to almost pause this video and just ask yourself, why is it that we did not incorporate that unrealized profit in this calculation? Now, the answer is simple. It is that profit, that unrealized profit, is not sitting at a subsidiary level. Consequently, we don't need to adjust. Remember, the question is asking us, calculate the non-controlling interest. And the non-controlling interest is only owned within the subsidiary. Yeah, so that's why we are not adjusting that profit, because that unrealized profit is sitting at that parent level, and that will be eliminated when you are doing the consolidation process. But this question requires us to calculate the non-controlling interest share of the profit. All right, so now we have calculated the non-controlling interest in the opening retained earnings. We've calculated the non-controlling interest in the profit. So by just doing that, we obviously come up with the non-controlling interest in the closing retained earnings. So we don't need to do any adjustments to the closing retained earnings. If you have already done the adjustments at the opening retained earnings and you've added the profit for the year, the effect is that you've already adjusted the closing retained earnings. However, if you wanted to, your starting point to the closing retained earnings before any adjustments, so put non-retained earnings in. So there are two ways to calculate the non-controlling interest in the consolidated retained earnings. How would you go about that? Simple. You take the closing retained earnings, but then you remember that you need to adjust the unrealized profit tax, the unrealized profit. Remember the inventory, but also remember the tax effect. And so basically what happens is, this is the closing retained earnings. You deduct the 40,000, which is the unrealized profit on inventory, but then don't forget the tax effect, which has the effect of reducing the effect of the profit on, or how much you reduce the profit of the subsidiary by. And so when you do that, you end up with closing retained earnings of 33,600. The other alternative way is exactly what we have done. You take which we did. You adjust the opening retained earnings. Remember, we did that. You adjust the interest, the non-controlling interest in the profit. Remember, we did that. And then don't forget the non-controlling interest in dividends. We hadn't done that. So that also needs to be adjusted. So you should be able to know that this figure, you know where that came from. We calculated that before. We calculated this as well. The figure that we didn't calculate is the $30,000. And so that is adjusting for dividends. Now, sometimes you might find that there are no dividends being paid out, and that's fine. That means that you don't need to adjust for dividends. But if you realize that the subsidiary declared dividends, then that needs to be adjusted. And in this case, they did, and so that is why we are adjusting. And so when you adjust, you can see we arrive at the same figure. So now, let's move on to the next year. At the end of 30th June 20X5, what's going to be the non-controlling interest? Now, I want to ask you a question. What do you think happens on 30th June 20X5 when it comes to unrealized profit in inventory? Remember that inventory was sold to the parent, but the parent hadn't sold it to external parties as at 30th June 20X4. But we were told, subsequent to year end, in the year 30th June 20X5, the parent company sold that to external parties. And so basically what we are saying therefore is that that unrealized profit became realized. So how would you calculate the non-controlling interest as at 30th June, at the end of 30th June 20X5? We start with the opening retained earnings as at 30th June 20X5. And we did come up with this figure previously. So that's 33,600 that we calculated. You can go back to your notes or to this video and you can see how we calculated that. Now, remember, like I said, all the inventory was sold and consequently the unrealized profit is now realized. So the non-controlling interest will now be entitled to its share of the profit after tax, which will include that realized profit. So how do you calculate that? Basically, you say, what is the current after-tax profit in the financial statements of the subsidiary? So you look at, in the year 30th June 20X5, we now ask ourselves, what is the non-controlling interest in the current profit? Now, what we basically do is we start off, similar to what we did in the previous year, we start off with the current tax profit in the financial statements of the subsidiary. And so basically what we say is, what is the current profit in this year, 30th June 20X5? Then we ask ourselves, was there any unrealized profit? If there was, we deduct that. Obviously, we don't also forget the tax effect of that profit. And then we say, we need to add any unrealized profit in the previous year that is now realized. And that will give us the non-controlling interest in the current profit. Now, that essentially is, remember we had a realized profit in inventory this year, which was unrealized in the previous year, but also we deduct now the tax effect on that realized profit. And so basically what will happen is this year's profit is 100,000, 40,000 is now realized profit. Obviously we deduct the tax because we are going to be taxed for that. And so what we end up is 30% of 128,000. And so there, the non-controlling interest share is 38,400. Now, you could have easily calculated this by just taking the 200,000, which was earned last year, plus this year's 100,000, and calculated 30% of that. And that would have still given you that particular amount. So which is also 90,000. So that would be 51,600, which we've calculated, plus that 38,400. Now, notice, however, that you can only do that if there is no unrealized profit. So there are a few statements here that I want you to have a look at, and you can read that. But basically what I'm saying here in a nutshell is, if there is no unrealized profit, so let's assume there was unrealized profit last year, like in this example, which has become realized this year. That means that there is no unrealized profit when you put those 2 years together. Consequently, you can just directly go to the closing retained earnings and calculate what the non-controlling interest is, because there are no adjustments to be made. But if there are any unrealized profits, then you need to be very careful about that, because you need to adjust those for those. All right, so in this question, the non-controlling interest in the closing retained earnings will be calculated as follows. So you take the closing retained earnings, you deduct any unrealized tax profits. Now remember, there were no unrealized tax profits this year. And so this calculation is fairly straightforward. It's just 30% of 190, which is 57,000. Another way of calculating this is saying that is equal to the opening retained earnings plus the profits less the dividends. And we've calculated most of these figures. So we have the 33,600, which we calculated as the opening retained earnings. We have the 38,400, which we calculated. What we haven't calculated is the 15,000, and that's simply 30% of the dividend that was declared. Now we have the 57,000, which is the non-controlling interest share in the closing retained earnings. So it's very, very important when you're doing such a calculation, not just to cram or try to memorize the formula, but to understand what is happening. So that brings us to the end of this discussion.